All righty. Good evening, everybody. Let me share screen here. All righty. Welcome, gang, 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 gang. Let me make sure that everybody is muted. Close some of these other windows I got. How's everybody doing? How have the last few days been? How is everybody doing? What's good? What's good, everybody? What's the tea? What's the tea? Is there any tea? It's my birthday today. Chris Berry. Hey, Chris, my man. Happy freaking birthday, my guy. I'm super excited and appreciative that you're here on your birthday. That shows serious dedication. Honestly, I respect the hell out of that. Somebody's birthday tomorrow? Aaron, happy early birthday, man. Damn, guys, happy birthday. Hell yeah. That's a great way to start off the night. Hell yeah. Hell yeah. Yeah, for real. Dude, drop the Venmos in there. Mike, make sure you mark those down. I'll come back to that after we're done with the lesson as well. All right. Make sure the first drinks on the birthday bender is on us for sure. Well, welcome back, everybody. It's been what is it now since we last spoke or we last had a lesson on Thursday night. So it's been 3 or 4 days, 4 days now since we had our last lesson. And I know that 4 days is probably not enough time to fully digest everything that we talked about. Today was a very fun day in terms of the trading that we had, but also just in terms of conversations in the chat. I had a really good opportunity to just have good back and forth in the mastermind questions areas, in the mastermind chat area, as well as the trading floor. And I saw a few people mentioning that, lessons 3 through 5, it's great, but it's a lot of info. And you're not wrong. This is very, like I mentioned, I've done this now 10 times. So this is being the 10th. I now have this down to a science in terms of how I think we should progress naturally through this program, right? Like I mentioned, throughout the course of this, there are these 8 lessons, and throughout each lesson, there are very key things that are, in my opinion, required for you to understand in order to fully understand the strategy that we are going to be trading, right? So there are little segments and things of each individual lesson that I want to, and we're going to tie back in the end that kind of makes up our larger strategy, right? So the last 3 lessons we had were extremely thick. And again, that is very intentional. In my opinion, when I was learning charts and strategy, I wanted it all at once in the sense. I wanted it to be like that. Once in a 7-day period, I get those lessons as well as the bonus stuff all in this sort of once. That way I can binge it in a sense, right? So now we've given you a lot of material over the course of the last few days, right? You've gotten those 3 lessons, which are all close to 2 hours. They're all extremely thick. But in my opinion, I do a good job of keeping it straightforward, on track, moving forward. It's not, in my opinion, there's not much like wasted time, so to speak, in those lessons. There's not much like downtime, right? It's a whole lot of very intense conversation. Now, in addition to that, you all also have access to the bonus lesson. So we made an announcement about this. Spoiler alert, we can see in the back end who has completed what portions of the course as well as of the bonus lesson. So we actually went through, and for the first time I did like a larger check just to see, how many people have fully finished every bonus lesson that was there. And while we didn't start using Kajabi to like Mastermind 7, so there was an excuse for some of the earlier students. Some of the end students, some of the most recent students is kind of like to ask that question, like, hey, like, why haven't you finished all the bonus material? Yeah. So for me personally, I consider it's bonus material, but I would consider it like part of the course, right? Like it's, in my opinion, a requirement. I wouldn't just skip past that and be like, oh, I think I understand multi-time frame analysis. I'm just going to not watch all the bonus lesson examples on it. That's fine. You'd be selling yourself short, right? It'd almost be like you're not putting in the work to really get where you want to be, right? So each example is different. Truth be told, The example that we had in our most recent class was definitely, in my opinion, one of the strongest examples. I think naturally, as I present this material, I get better and better, right? So I think that we had a really strong example. That being said, there are some absolute gems that I want you to go back and watch all of them. There are some bar by bar reviews that, again, intentionally, you wouldn't understand the material in those bar by bar reviews if you hadn't had gone through the first 3 lessons first, right? The 3 through 5. So I wasn't intentionally trying to gatekeep anything from any of you who are more advanced and were just waiting for those bonus lessons to drop. Promise you, I wasn't trying to gatekeep. Just in the past, before, what we've done is we've given access to that early, and people got ahead of themselves, right? And next thing you know, they were asking questions about stuff out of order, and it just became kind of a mess, right? So now you have literally everything. Like I mentioned, we are going to cover a lot in lesson 8 that sort of ties everything together. We're going to cover how we find the stocks that we're trading each morning. We're going to cover our pre-market routine. We're going to cover how do we pick one stock versus another stock. We're going to cover all that stuff. That being said, in terms of reading a chart, you literally have it all now. There is no more element of like strategy that I'm like waiting to reveal and be like, oh, like this is like a secret weapon, so to speak. No, like you have it all. Right? It's now just going to be a matter of refining it, picking, okay, what is the best stocks that I can find each day? How am I going to create a morning plan? That way I can figure out what I'm anticipating following that morning plan. We're going to nail down all the intricacies, but the last 3 lessons are very intentionally thick so that you have literally everything, right? So from here, over the course of our next 2 lessons, what we do is we're going to spend our time kind of taking a step back, in a small sense, a very small sense. We're going to be taking a step back. These next 2 lessons are going to be likely closer to the 1 hour mark rather than the 2 hour mark. And what we're going to be doing in these next 2 is covering instruments that we use to trade, right? So in this lesson, we're going to do a deep dive on everything options. I wouldn't feel like I'm setting people up to succeed, considering we trade options on a daily basis, if I didn't talk about the intricacies of how I use them. And then in our next lesson, we're going to cover more advanced option strategies, as well as futures and what they are, how they work, how you can get funded, everything in between, right? So the next 2 lessons, we are going to take a step back from the strategy and rotate more into, okay, how do we find the instruments that we trade to actually make money each day? Using options is a huge part of what I do, right? Trading shares, you could do the same thing with the same R to R type of concepts, but the returns you'd be able to generate just wouldn't be anywhere similar, right? So the next 2, we're going to do that. In lesson 8, we're going to come back and we're going to circle and tie in stuff from lesson 1, from lesson 2, from lesson 3. It's going to be the most epic review / combination of tying everything together of all time, right? So in the past, I have had a very few number of people DM me and they say, hey, Jake, I came into lesson 6. I really loved the course. Lesson 6, I already knew this stuff, blah, 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 blah. And I was like, hey, I love you. And they're like, I wish we could have more technical strategy. I was like, hey, I love you. That is what the bonus lessons are for. I know that there are some of you out there who want more strategy from me. So I give it to you all in the form of now, I think it's like what, 20 or 15, 16, 17 bonus lessons, whatever the number is, right? That is now the form of the more in-depth technical that we get, right? So now we have to go through this information because, in my opinion, in order for you all to succeed as traders, you need to be very familiar with the instruments that we trade, right? So I just gave a very long introduction, but I promise you we are going to move very quickly through tonight. So I wanted to make sure that we are all on the same page, right? So in tonight's presentation, we're going to be talking mainly about the instruments that we trade on a daily basis, which are options, right? Given the fact that I am teaching you all how to trade like me, it would be an incomplete course if I didn't talk about exactly how I used options, as well as how I determine what strike prices and such I am going to choose, right? So in tonight's lesson, we are going to move quickly. For those of you who are newer to options or newer to trading as a whole, it might feel like we are moving very fast. I promise you, don't fret. This is not the subject of all the subjects that we cover to worry about. This is the one that on a rewatch or on a little bit deeper of one question you ask, you're going to figure it out. This is information that you can for sure grasp the concepts of. I am more worried. There's a reason we go through this particular concept in an hour, and I give you 20 hours of multi-time frame analysis concepts of material, right? There's a very specific reason. So if it feels like we're moving fast, don't worry, we will not leave you behind. I just want to talk about this in a very efficient manner, right? Because I think that most people who teach options end up teaching options and going into a level of depth they don't really need to go, because that stuff isn't super applicable to them, right? So that being said, enough with the intro, let's get started. So first up on the options agenda, so to speak, for tonight, we are going to do the quickest yet most fulfilling presentation on the Greeks you have ever seen. That way everybody is familiar with what the Greeks are, how they operate, and everything in between. We're going to talk about how options are priced, what makes up a certain options pricing, including this week. Options are very expensive. If you look at any individual name, the options that are being traded for them are very expensive, and we'll talk about why that is. We're going to talk about expected moves and how we utilize them in our trading, and then we're going to talk about implied volatility and how we can pay attention to that in our trading as well, right? So first up is the options Greeks, right? The Greeks themselves are like the foundation of options trading, so to speak, right? They are themselves the combination of all the Greeks in conjunction with the implied volatility of an individual name basically makes up how the option is priced, right? So there's a whole bunch of words, but really what the Greeks do is they measure various dimensions of risk on the option that you are trading, right? So when talking about the Greeks, normally people go through a very in-depth presentation, give you a whole lot of information overload that, in my opinion, isn't all that important. There's really only a few takeaways that you need to have from the Greeks to fully understand how options move, right? So first we'll start with delta. Delta is probably the most quote unquote important concept for you all to understand from a Greek perspective. Delta's definition is that it measures the rate of change of options premium based on the directional movement of the underlying. Now, that's a lot of fancy words. Basically, what it really means is that for every $1 that the underlying moves, aka if you're trading the SPY, for every $1 that the SPY moved up or down, your option price would increase or decrease by roughly the delta. Right. So here on this options chain from Thinkorswim, you can see the deltas here. Now, depending on the broker that you use, sometimes it will be displayed between 0 and 1, aka right here it's displayed as 0.5. On another broker like Tastyworks Interactive Brokers, they're going to display it between 1 and 100. So it'd be like 50. It's the same thing. It's just on a different scale. Right. But really, the biggest takeaway that you need to have from Delta is that if a stock moves up $1, the expectation is that your contract would move up roughly $1, right? Not exactly, but roughly, right? Now, the biggest takeaway that I want everyone to have aside from that on Delta is that Delta is not fixed, right? As the stock moves, your Delta is going to change. So let's say that you used this example from this options chain here, and you purchased the 124 calls, right? As that trade works in your favor, your Delta will either increase, or if it works against you, your Delta will decrease. Right? So delta is not fixed, meaning that this isn't a perfect science. This isn't an exact number that you are going to be able to calculate, knowing exactly how much your options price will be based on according to the delta, right? You'll be able to get really good close estimations, but you should understand this broad idea that delta is dynamic. It's not fixed, right? So much like your R multiple, delta is always changing. Realistically, you don't have to pay attention to it too much. I just want you to understand that concept, right? So really, at the end of the day, with everything I've said, what I want you to kind of, another little note to grasp, right, is that basically the higher or the more in the money your contract is, the higher delta you have. The more out of the money contract you have, the lower delta. So here you have a 126 calls. It's more out of the money. Those are trading with a 0.40 delta. You have something here that's more in the money. That's trading with a 0.61 delta. So as you are more in the money on your options contracts, your delta will be higher and higher and higher. And we'll talk about how that plays a role, particularly in zero DTE options as well. Delta. People make a big huss and fuss about it. In reality, delta is however much the stock moves up or down $1, you can expect your options price to adjust by the delta. It's not an overcomplicated thing. And I don't want you to overcomplicated thinking, right? I will say, I do not remember the last time that I actually checked the delta of a contract I'm trading. Now, as I teach you all the formula that I use in order to pick the strike price, for the next couple of weeks or months or however long it takes you to kind of get in a rhythm with it, you are probably going to check the delta just to make sure you're trading a strike price that falls in under the category that I'm going to relay to you in just a few minutes. But after you get the hang of it, it's going to be a type of thing where you know what options are like reasonable for you to trade, right? It's kind of this thing where I don't love being like, I always hate when educators like, with experience, you'll learn it. There's a lot of things in this field, though, where that's true, and this is one of them. When it comes to selecting a strike price right now, early on, you probably, if you're following the rules I'll lay out in a few minutes, you'll probably check the delta. That way you can get in the rhythm of choosing a strike sort of within that range. As you get experience, though, I haven't checked the delta in like 3 years, and I don't think I will for the next 3, right? It's the kind of thing where I understand this as a concept. That's good. Now I'm on to the next, right? So the next concept we have here is the next Greek that we have is gamma, right? So like we mentioned in the previous slide, delta is not fixed. It is not one number that stays the same. It's dynamic. As the stock moves up or down, your delta will increase or decrease, right? How much your delta increase or decreases by is known as gamma, right? So gamma is essentially the rate of change of delta itself. So here on the options chain, you can see that all of these contracts have a gamma of about 0.05, meaning that if the stock were to go up or down $1, your delta would adjust by 0.05, right? Again, a whole lot of words that's like, how am I ever going to use this? You're probably not, right? For me, I have never once actually looked at what gamma is, like the number behind it, but the reason gamma as an understanding is important to have is how it affects your zero data expiration options, right? So again, of the Greeks, at no points in time, maybe besides delta when you're selecting a contract in the beginning, do I expect you to actually check the number on the Greeks. I want you all to understand the concepts, right? So gamma, the concept behind it is that as you get closer to expiration, your options become more volatile. So a lot of people think that zero data expiration options are driven by a high delta or theta or whatever. In reality, it's gamma. Gamma is the variable in this equation that is like fighting time, right? So as you get closer to expiration, your options become more volatile because your delta fluctuates at a more rapid rate, right? Your delta could go from 1.0 being in the money to 0 being out of the money in the span of 10 seconds with no time left on that contract. AKA, as you get closer to expiration on your contracts, they get more volatile. So that's the takeaway that I want you all to have from the slide. Gamma, right? As we get closer to the expiration of that contract, those contracts become more valuable. Or excuse me, those contracts become more volatile. Excuse me, let me re-say that. As you get closer to the expiration of your contracts, of those options contracts, the contracts get more volatile, and that is because of your gamma, right? The contracts get more volatile, right? So next up, we have on our options Greek list, we have Vega. And as of Mastermind like 7, I think it is, I actually just skipped this as a whole because I have never once looked at Vega. And in reality, the part of Vega that actually impacts us as traders, we're going to have a conversation about that in implied volatility in just a few minutes. So guess what? We're not going to talk about Vega. Don't worry about it. I've never once looked at it, never once paid attention to what the actual number is. We'll come back to this subject once we talk about implied volatility, right? Because it is important for you to understand concepts of implied volatility 1000%. Next, we have what is arguably the most well-known Greek. Really what people, Theta is really well known for is being everyone's trash can, right? Like everyone loves to blame Theta for all of their problems, right? It's like, oh my gosh, Theta is hitting me. Theta's hitting me. Oh my gosh, Theta. And you're not wrong in some sense. Time decay does play a role in contracts, but it's funny to me because it's become very much like an excuse for people when they're trading zero DTEs. When in reality, it's a trade that they never should have been in, right? But Theta, as a definition, measures the impact of premium based on time left for expiration. Basically meaning, right? Again, fancy words. No, simplified as Theta is time decay. Right? So theta measures the rate of decline in an option based on passage of time, right? So basically, as you get closer to your expiration, your options will start to decay a little bit because
GT71 disconnected.
I don't know if you heard that, but my speaker just yelled at me. But as you get closer to expiration, your contracts lose time value, right? Which we're going to talk about in just a few short minutes to make sure that everybody's on the same page. Pause. I got a message from a team member. I want to make sure nothing's on fire. Okay. Okay. There's nothing's on fire. We're good. All right. So in essence, as we get closer to expiration, theta decay comes into play for our contracts, right? And it starts to impact you, and these lose value simply due to the fact of time passing, right? So here's the example of it that I want everybody to take away. Let's say that theta has a number of 0.41, right? 0.41 there, 124 calls, right? So the AMD 124 calls have a theta of 0.41. Basically what this means is that the next day, if AMD were to open up completely flat, right, and it had not moved up or down at all, assuming all other factors equal, including implied volatility, all that, we would expect that contract to lose roughly 40 cents of value, right? So that's what theta means. That's the math behind it. I swing trade weekly contracts a lot. I don't check the math. I'm not worried about that. Usually if I'm swinging a contract, I have anticipations of it making such a move that theta is not a primary concern for me. So again, like the other Greeks, theta and Greeks are a more concept that I want you to understand rather than an exact science that I expect you to be calculating on every single day, right? So really the visual takeaway for theta that always helped me is this graph here where it kind of displays when theta actually kicks in, right? So theta decay is exponential, right? So as you get closer to expiration, your theta decay starts to become more and more noticeable, more and more extreme, right? So if you're trading an options contract that's out 90, 100 days till it expires, you're probably not going to be suffering any theta decay overnight or on a couple of days, right? Really the number where it starts to, and I've heard this number, some people say it's 30, some people say it's 45 days, whatever the actual number is, right? As you get to like that 30 to 45 day mark on options contracts, they start to decay a lot quicker, right? So your theta starts to get larger quicker. The exponential, what it means is as you progress, it starts to become more and more aggressive, right? So as you get into the final week or so of an options contract, the theta is going to be significantly more impactful to that options contract in that last week or day than it is relative to the previous week or day, right? So as you get closer to expiration, theta decay becomes more and more exponential, right? That's really the conceptual takeaway that you should have from the Greek theta, right? So as option buyers, theta is not your friend. Typically speaking, theta and time decay have a negative effect, right? It's usually not like in your favor when you have theta decay as an option buyer. So when you're looking for a longer term swing trade, and I'm talking 6 to 9 months, right, kind of thing like that, which I don't personally do that much anymore, you would want to look for a contract with a relatively low theta. Spoiler alert, anything that's out 6 to 9 months will likely have a relatively low theta. It's just if you're trading on a very volatile name at that point in time, like a small cap, that could potentially start to even theta could impact you even on longer dated contracts, right? Now, what we're going to talk about in tomorrow night's lesson is how option sellers can actually use theta to their advantage to collect premium every day, right? If you buy the AMD 124 calls and the next day they open up down 40 cents of value because AMD didn't move, you lost money, but whoever sold you those options contracts probably made money. And tomorrow night's lesson, we're going to talk about why and how that is, right? So finally, the last Greek that we have on our list here is rho. I'm going to be completely honest with you all. I've never fully understood what rho does. I think it has something to do with interest rates and large portfolios and I don't know, the margin. I don't know. I wouldn't worry about it because I seem to be doing just fine and I've never once fully understood what it is. So I wouldn't worry about it too much, right? And with that, my friends, that is, oops, that was a random slide. With that, my friends, that is, as promised, the briefest presentation on options Greeks of all time. In my opinion, I want you to understand the concepts of deltas, gamma, and theta. If you understand conceptually that delta measures how much your options contract should move up or down, and then gamma, you understand, basically means that 0 day to expiration options are going to be super volatile. And theta basically means that as you get closer to expiration, options become more susceptible to time decay. You understand the Greeks as much as I want you to. And for me personally, that is all I do with them. So if you're somebody out there who is a little bit confused, I wouldn't worry too much because I would not. This is stuff that you need to have that conceptual understanding of. Once you have the conceptual understanding, you're good, right? I wouldn't be doing my duty as a fiduciary or whatever you want to call it to you all if I didn't teach you that information. But in my opinion, don't let people drag you down a rabbit hole that's far deeper unless you want to do more advanced option strategies, right? So next, we are going to quickly move into the next stage of our presentation here, talking about options pricing, right? So we're going to quickly review what is an options premium and what is that options premium consist of. We're then going to talk about intrinsic and extrinsic value and how we utilize that information to pick a strike price for our contract. Then we're going to talk about in the money versus out of the money. We're going to talk about expected moves, and we're going to talk about implied volatility and implied volatility ranking, right? So first, you have probably heard the term options premium several times over the course of the last few weeks, or just your life in general, right? An options premium is basically saying an options contract, right? The premium is just what consists of that contract, right? So an options premium has two factors, right? We have intrinsic value and extrinsic value, right? So intrinsic value represents the value of an option itself right here, right now. So basically meaning if you were to take that option and exercise that option, right, you would be able to capitalize on that, right? And it would actually hold some real value, right? An extrinsic value is representative of time value and implied volatility, basically meaning that if you tried to exercise that option right now, you wouldn't be able to do anything with it because it doesn't have any intrinsic value, right? So you think about this when it applies to options and how we trade it. Basically, what it's saying is that in the money contracts are going to have high levels of intrinsic value, right? So anything beneath this 124 line, all of these are going to have high intrinsic value, right? AKA there's going to be a dollar value that they are actually worth right there, right now, right? So because in the money options contracts can be exercised right now, they will all have an intrinsic value that can be capitalized on, right? In addition to that, all options in general, both in the money and out of the money, will have some form of extrinsic value until those options expire, right? So it has the intrinsic value, and let's talk about exactly where that comes from, right? So an options premium, as we just discussed, comes with two factors, right? The intrinsic and extrinsic value. So the intrinsic value represents the actual value of the option itself right here, right now, right? So let me do this real quick. All right, so let's say, for example, that we were looking at the AMD 120 calls. At the closing of this price, right, the AMD 120 calls are priced at a midpoint. Again, the bid ask is 40 cents wide, so we're going to call it a midpoint just to make math easy, of 520. The AMD 120 calls are priced at 520. So we can actually calculate what the intrinsic value of that option is right here, right now. And this is important to us, right? So for this particular setup and math equation, right, we have the AMD 120 calls are priced at 520, like we mentioned. AMD's stock price is, sorry, I'm getting blown up from my mom. Okay, sorry, everyone. Please give me 10 seconds. I got to pause this. Okay, I'm back. I apologize about that. All is good, right? So the AMD 120 calls here, right, are priced at 520, meaning that if we were to actually try and figure out how much are they worth if you were going to exercise them right here, right now, right? In order to do that equation, you're going to take the stock price, which we have just said is 123.67, right? And we have the options price, which we have said is 520, right? Excuse me, the strike price, which we've said is the 120 calls. Let me bold that. Right. And from there, we can determine what the actual intrinsic value of this contract is. So using this equation here, taking the stock price and subtracting that strike price, we know that these 120 calls, if you were to exercise them right here, right now, at are worth $3.67. Right. So an in the money contract has both intrinsic and extrinsic value, right? So let's go into this next slide here, right? Because we've talked about how those AMD calls are priced at 520, right? We just did the math on that equation to figure out where $3.67 of that 520 comes from. That's the intrinsic value, AKA if you were to take the stock price and subtract your strike price, you can figure out the value that those contracts will for sure be worth. These AMD options contracts, as long as AMD stays above 123.67, these 120 calls will never be worth less than $3.67 ever. That's for sure. But like we talked about, options do have an element of intrinsic and extrinsic value. All options will have extrinsic value until the day that they expire, right? So we have an options price here of 520. We've just determined that 367 of that is intrinsic value. That leaves us with the remaining part of this options contract, $1.53, being representative of the extrinsic value. AKA, this contract likely had 2 or 3 days till expiration, and the market was pricing in that AMD could have moved $3 or $4 up or down, right? And the option price needed to account for that potential volatility, right? We can talk about a lot more in just a second. So if it's been confusing, I know that hiccup was kind of a hiccup, but don't worry. I promise you, this is the kind of thing that will absolutely make sense. The biggest takeaway that I want everybody to have from this particular slide is the ability to calculate intrinsic value, right? Which is basically this very simple formula. It's stock price minus strike price, right? And what that will help you do is be able to calculate what your option will be worth if you're at a certain price on the chart. And we're going to talk about that in just a second, right? So we just talked about how an in-the-money options contract, you can calculate intrinsic value, right? The biggest difference between in the money and out of the money is that out of the money has no intrinsic value, right? In out of the money contract, if you were to try and buy these 126 calls on AMD, and then you call your broker and you say, hey, I want to exercise these contracts right now and I want to buy them, right? I want this to work. Your broker would laugh and they'd say, that sucks. This isn't in the money, right? They're not in the money. So you can't actually exercise it, right? So out of the money options pricing are based purely on extrinsic value, meaning the fact that there's 3 or 4 days left till expiration, right? And the market is pricing in that AMD could move a certain amount up or down, means that these options could end up in the money. So they have some extrinsic value still, but they have no intrinsic value. AKA, you wouldn't be able to calculate exactly how much they are worth, right? Because you can't figure out the intrinsic value. These AMD 126 calls at AMD 125, you can guesstimate how much they'll be worth, but you can't figure out the exact number because they are not in the money, right? So that's very key in terms of how we select our strike. And we're going to talk about that again in depth in just a few minutes, right? So, okay, moving on from intrinsic value versus extrinsic value, the next logical segue here is into what's known as expected moves, right? So expected moves for us aren't something that I use as like a daily part of my strategy, but it's a broad concept and understanding, especially for earnings moves that I want to make sure that I am up to date paying attention to, right? So expected moves are basically the amount that a stock is predicted to increase or decrease from its current price based on the current level of implied volatility, right? So that's a whole lot of words, right? But in reality, expected moves are factoring in, right, how much a stock is literally expected to move over the course of that time period, right? So each broker does have a different formula that they use. Tastyworks has a slightly different formula than Interactive Brokers. There's a slightly different formula than Thinkorswim, whatever. The easiest way to calculate the expected move is simply add together the price of an at the money put right here and an at the money call, which you can't see on the slide, but it's on the other side there, right? However, in reality, I've never once actually done that equation myself, right? Where you will find this number is right here. On the top right, you'll see this plus or minus sign. Whatever options chain you're on, it's still probably in that top right corner. I'm like 90% sure on IBKR it's there. I know on Tastyworks it's there. I know everywhere. It's pretty much always right there. And that plus minus essentially is telling you, okay, for this particular options expiration day. So let's say on this day, there was 4 days left till these options expired. There's 4 days left till these options expire, right? The price, the stock AMD is expected to move up or down $6.50, right? That's what the expected move is telling you from this particular conversation, right? Or this particular element, right? So expected moves are basically going to be a gauge of how much are we thinking that stock, how much range do we think that stock has over a certain number of days, right? So it's important to understand that expected moves will be larger if there's an upcoming catalyst for the underlying stock, right? So for example, earnings reports, FDA, pharmaceutical announcements, event days, Amazon Prime days, FOMC days. FOMC is a great example, right? As the expected move for this week is significantly higher than normal due to the FOMC, right? Those will all contribute to higher than normal implied volatility and subsequently larger than normal expected moves, right? So basically, when there's a potential catalyst for the stock, the expected move you can expect it, pun, to be higher, right? You can expect it to be larger, right? If a company is reporting, if you've been wondering, hey, why are the Meta options so expensive this week? Why were Google options so expensive? It's because they had an earnings report. And because there's that uncertainty or potential volatility in that name, options prices have to be more expensive to account for that volatility, right? So the expected move is based off of three factors, right? First is the current stock price. The next is the implied volatility. Finally is the number of days left until expiration. So there actually is some pretty cool math behind the expected move. I'm not a math person. I was never great with like bell curves, standard deviations, that kind of stuff. But expected moves, the math behind it is actually one standard deviation, right? So in theory, right, one standard deviation encompasses about 68% odds of something happening within one standard deviation, right? If you go far and extrapolate that information, you say, okay, now I want to take it within two standard deviations, all of a sudden that number becomes significantly lower, right? Or excuse me, significantly higher. You go from 68% to like 98% or 95, then 98, right? So again, I'm not a math person. This was never something that like really clicked with me. But if you are somebody who's an engineer or a statistician who's really behind the numbers of it, then I'm really excited for you in our next lesson to learn about option selling, because you can start to take advantage of the chart information you learned over the last few lessons and then combine it with probabilities in option selling. And it can be a very powerful tool if you are a math person that likes to bet on, with standard deviations, right? So why does this matter for us, right? Why does the expected move matter for us? Jake, everything you've talked about tonight has had some sort of larger meaning for us. Why does the expected move matter, right? Let's think about this. If we can anticipate how much of a range we should expect on a certain stock for a certain period of time, that can help us make a decision on whether or not we're interested in trading that stock, right? So it's greatly beneficial for us to figure out, okay, this is how much of a range we expect over the course of the next week or two, right? For earnings reports, it's very important to pay attention to. And for MMM today, it kind of played a role in my thought process because we had exceeded the expected move. I thought we were going to get continuation above that expected move that we had, right? Now, when you're trading credit spreads, it's super important to be on top of expected moves because expected moves are often the entire basis of the trade. And credit spreads, we're going to dive deep into tomorrow night, right? So, all right, everybody, we did not have a super long lesson tonight. Let's take a pause and a pre-break here, a quick one. We're going to be back in like 2 minutes, and then we'll come back and we'll wrap up the last 20 to 30 minutes and make sure that we are all aligned and on the same page for implied volatility as well as the beginning of options. All right, so everybody pause, pre-break. We'll be back. All right. Pause. All right, my friends, let's get back into it here and talk about implied volatility and how that plays a role in our trading and paying attention to the contracts that we trade, right? So first, implied volatility as a definition is a metric that gauges the market's view of a given changes in a security price. Again, a bunch of mumbo jumbo. Really what you need to take away from this is basically the higher the implied volatility, the larger move that the market is expecting out of that underlying stock. Thus, the higher the implied volatility, the more expensive that options are, right? Typically, you want to avoid buying options in a high IV environment, right? So typically before an earnings report, you would want to avoid buying options as the implied volatility is going to be extremely high, right? Now, there's this analogy that was given to me that I thought was a really good analogy for understanding how implied volatility works. And if you think about it, back in the day of 2020 COVID days, and I know that it seems so far away now, and I know some people don't think it was real or they don't, whatever. I don't care how you feel about it now. In those first few weeks, that shit was scary, right? Nobody knew what it was or how deadly it was or the potential of it. It could have been much worse, right? In theory, based on what we know now, right? And for those first few days, first few weeks, hand sanitizer, the price of it was crazy through the roof, right? The supply and demand of hand sanitizer has been gut nuts because nobody knew when they were going to be able to get their hands on hand sanitizer again, right? And they didn't know how long it would be until it would be able to come back into the market, right? So anytime there was hand sanitizer on the market, people were paying a crazy premium price to get hand sanitizer to try and keep themselves safe from COVID, right? So the analogy here is basically that sorry, I'm lost in my own brain there, trickling up a little bit. But the analogy is basically that hand sanitizer, right, before COVID was in a low IV environment. It was a very stable asset. It was the normal price. Hand sanitizer price did not fluctuate very much because there wasn't any reason for it, right? Then when COVID came along, there was this unknown catalyst type of event, right, that could have potentially, we didn't know in the beginning. We were fighting over toilet paper, right? So in the beginning, in theory, when you're buying hand sanitizer in March of 2020 at 3x the price of normal, you're doing it because you're fearful, right, that it might go higher, crazy higher, and you won't be able to purchase hand sanitizer one day. Basically, the unknown of COVID or the unknown of an earnings report can cause, right, the price of that asset, being hand sanitizer or a stock, to be extremely high, right? So for us, implied volatility, basically think about it when an earnings report is coming up, it's basically like buying hand sanitizer during COVID. You're going to be paying the highest possible prices because there's that element of unknown coming, right? That could impact prices heavily in one direction or the other, right? That being said, it's important with implied volatility to understand that it's different for every stock. If you look at a stock like Roku or a stock like NIO, those stocks are always going to have a higher implied volatility than a stock like Microsoft. Right? Microsoft has a very large market cap. Even on its earnings report days, it's not going to have the implied volatility that a stock like Roku does, that is a significantly smaller market cap, right? So as you can see here, right, we have up top, we have Microsoft, which on Thinkorswim is showing about 30% implied volatility, right? Then you look at a name like Roku and it's showing about 60% implied volatility. Then you look at a name like NIO, an even smaller cap, and it's showing about 180 to 200% implied volatility, right? So these numbers are all over the place. And in reality, it's really hard to gauge what they mean when comparing them to other stocks, right? So what's really most important when it comes to implied volatility is the IVR or IVP of an individual given stock. It's the same thing, just some brokers call it IVP, some brokers call it IVR. It's very annoying, right? I think on Interactive Brokers, they call it IVR. On Thinkorswim, they call it IVP, right? So basically what that number is an implied volatility ranking, right? So it gives relativity to implied volatility, basically meaning it takes the numbers of like the last 6 months or the last year and says, how expensive are these options for this individual name relative to the last 6 months, right? Something like that, right? So in a normal market, which I don't think that we've had for quite some time, but in a more calm and stable market, if you are worried about options pricing being too high, I would take a look at the implied volatility percentile or the implied volatility ranking. And in general, you look to buy options when IVR is under 30 or 40%, and you look to sell options when IVR is over like 60%, right? Generally speaking, in a normal market. Now, this is very similar to Delta in the sense that for the first few days or weeks of you selecting an options contract strike price after learning the information that I've provided, you'll probably look at Delta just to make sure you're in the range, and then you'll have it down from there. It's the same thing with implied volatility ranking. I've been trading the same names for so long now that I know how much their options should be, right? Like I know that on Monday, Meta options are usually like $3 or $4 for an at the money contract, right? Like I know that just by trading them for so long, right? So it's the kind of thing where as you become more and more familiar with stocks, you'll become more and more familiar with their options pricing, even on days where they don't have an earnings report. Like Snow doesn't have an earnings report, and I could tell their options were pretty expensive today, right? So there's something going on in the sense that those are a little bit higher than what I'm used to trading on Snow. And I just put that as a little piece of information in my head, right? So on Thinkorswim, in order to find the implied volatility ranking, you simply scroll down to the bottom of the options trade tab. You click today's options statistics, and you can see a whole lot of cool stats, including current IV percentile, right? So again, if it's over 40, I don't want that to necessarily deter anybody from trading that name, but start to think like, okay, relative to me checking this name in the past few weeks, are these options more expensive? Are they less expensive? You'll start to get like a mental gauge of this as you trade more and more names over time, right? So the biggest takeaway from implied volatility that I want to make sure everybody is on the same page about is how to not get implied volatility crushed, right? So let's take NIO as an example. Let's say that NIO reports earnings in the coming day and you are bullish on NIO stock. It's currently trading at $44 per share, right in that range, $44. You're bullish. You think NIO can go all the way to 50, right? So you purchase the same week calls, the 50 strike calls for $3.30, right? The next day, NIO opens up, let's say, and let's say it has a good earnings report, right? It's up 10%. Let's say it's up 10% and it's up $4 from its $44 price point all the way up at $48, right? Going into the day, you're probably on a high horse thinking, hell yeah, I'm about to make a bunch of money. NIO went up during earnings and I have calls, right? So when NIO opens up the next day at $48, why are you still down 70% of your calls, right? It's because you essentially just bought hand sanitizer during COVID, right? Now, COVID could have gotten a lot worse in theory, and that hand sanitizer could have increased in value, sure, but it didn't, right? And you bought when COVID was at its highest price. So essentially what you were doing here is purchasing hand sanitizer during COVID, right? You were buying $50 strike calls at the highest IV. And then even though NIO moved 10% in your favor, right? You were still down 70% on your calls because the IV was so high going into that earnings report. So the takeaway from this slide, my friends, is 90% of the time, 95% of the time, we do not purchase options prior to an earnings report. Very few opportunities do we do that. And when we do it, it was always sized for zero, meaning you are fully aware that it can potentially go to zero. I haven't personally done a pre-earnings trade in maybe like almost a year now. I'm not big. I think it was August of last year that I took like a $25,000 loss on CrowdStrike. I swung for their earnings because it looked really good on the chart, and then I got crushed. And I knew that was a possibility, but I also was like kind of like, nah, I'm right. This is gonna work, and then it did it, right? So I personally prefer to play earnings after the fact, much rather than like I like playing earnings after these options have been crushed a little bit. I like them opening up down 80%. And then me capturing that little bit of recovery that's small for them, but really big for me. Right? That's really the way that I like to play earnings more than anything else, right? So after going through all of that, I always like to give credit to a little bit of sources. there is this information is findable online, right? Investopedia options trading chip, born to sell. So if you have any confusion with anything that we just talked about, I encourage you to, one, do a rewatch of this lesson. I have a feeling it will clear itself up. Or two, simply ask a question in the questions channel, or much like you might have already in the Zoom chat. This is not a subject material that I expect to be uber confusing to people. It might just be initially a little confusing, but I promise you this is not the one to fret about, right? Again, I'm more concerned with people being confused on multi-time frame analysis than I am them being confused on implied volatility, right? So with that being said, why do we trade options every single day over shares, right? We always do our analysis on the stock chart, Jake. Couldn't we just trade the stock itself, right? There are actually pros and cons to each, right? Options are going to be cheaper, more cost effective. You're going to be able to get larger percentage returns. You're going to be able to have advanced strategies, and you can hedge more efficiently, right? That being said, there are some pros to shares as well. Dividends are one that you will see if you're in like a swing trade. They're lower risk in the sense that they're not as volatile. You can still lose more on shares if you take a bigger position size, but they're naturally going to be less volatile. You're going to have less active management on shares positions because you're not going to be super concerned about how options pricing is factoring in. And you're not going to have any deals with theta or any spread issues when you're trading shares, right? So there are definitely some advantages to trading shares. That being said, options are definitely far more effective for the vast majority of people in our program, right? They're cheaper. 100 shares of one stock versus one options contract price can often generate the same returns on a significantly far less amount of capital invested, right? So a $1, 1% move on a stock takes the stock from 100 to 101. That option will increase significantly more, a weekly expiration option, than that 1%, right? Again, you can also have more advanced strategies that we're going to cover in depth in our next lesson. Bullish, bearish, delta neutral, volatility-based, time-based options. Really, you can get crazy with it, with the different things that you can do. I honestly use them in a pretty simple manner. That's why I go through the options. Like this deck of slides that I could go through could be 5 hours, 6 hours worth of presentation material. I just don't do that because that's not how I use them, right? This is the Rake Trades Mastermind. I want to teach you how Rake trades. I use options in, like, in my opinion, the simplest possible way. I use them for leverage. There are a vast majority of ways to use options on a more advanced level in terms of more advanced combination strategies that we'll cover briefly tomorrow night. And that I encourage you, if that is somebody that resonates more with you, I would say book a one-on-one with Mullet, he or Joel. They'll be able to get you right when it comes to advanced option stuff for sure. But with that being said, let's take a deeper dive into how I use them. Like I mentioned, this is the Rake Trades Mastermind. So I want to teach you exactly how I use options on a day-to-day basis, as opposed to the traditional necessary ways that they are taught on a more advanced level, right? So what we are going to do over the course of the next several slides, and we're going to start this tonight and we're going to finish it tomorrow night. What we are going to do is dive through a variety of different option strategies. We're going to talk about a few that you're probably already familiar with, but we're going to talk about them on a level that also examines how I would choose a strike price for long calls, long puts. We're going to talk about short calls and why we never do them. And we're going to talk briefly about short puts, but really carry that mostly into our conversation in our next lesson, right? So first, this is the format that we are going to go through on these sides, right? We're going to talk about a particular strategy. We're going to ask the question, is it bullish? Is it bearish, or is it neutral? We're then going to ask the question, is this strategy a debit strategy or a credit strategy? We're then going to ask, does this strategy require directional accuracy in order to be right? We're going to ask the question, how do we calculate max risk? How do we calculate max profit? And then finally, we're going to ask, in essence, is this strategy one that we want to go long, short, or neutral on that individual given stock? So first, the one that you are all familiar with, the one that I personally probably trade 85% of my trades with, is what is known as long call options. Not reinventing the wheel here. Long call options are an inherently bullish strategy, right? You pay a net debit to purchase those calls. In order to be profitable, it does require directional accuracy. AKA, if you purchase Apple calls, Apple has to go up in order for you to make money. If Apple goes sideways or down, you probably lose money, right? The max risk on that Apple contract that you purchase is going to be the debit that you paid, aka however much you paid for that option contract is the absolute most you could lose. You can't go negative on however much you spent on it, right? Now, on an options call contract, in theory, that stock could go to infinity And by going to infinity, you could make unlimited profit, right? That doesn't usually happen, but it's possible, right? So in essence, when we want to go long on a stock, the simplest way to do so is to buy a call option, right? The option buyer has the right, but not the obligation to buy 100 shares per contract at that agreed upon strike price, right? So here, my friends, is the meat and bones of tonight's that I want you to take away, which is the process of elimination of Jake. How do I select a strike price when I am trading? Let's talk about it, right? So first, for me, I like to trade deltas that are roughly 0.3 to 0.5, right? Sometimes on my signals, I'll go a little bit lower, like 0.25, just to make sure that everybody, even smaller accounts, can participate in that trade if the risk is within my tolerance and their tolerance, right? But for me, the first equation of choosing, first part of the equation for choosing an option strike price is, can I find a delta within this 0.3 to 0.5 range, right? Next up, I look at round numbers. So I prefer to trade round number strike prices. Like today on Snow, I traded the 185 calls and the 190 calls. I did not trade the 187.5 calls. Now, some days, especially on like 0 day to expiration, I'm open-minded to trading those. But on the vast majority of days, I'm not interested in trading the half strike prices. It's not, there's no real reason to it. Sometimes they just have a little bit less liquidity. They have a little bit less liquidity than the round numbers, but I also just like the round numbers. It just works better in my brain, right? So a popular question that I get asked also is, Jake, do you look at open interest in volume before selecting a strike price or a contract? The reality is, for me, no, because all of the names that I trade, even the ones that aren't super liquid, have enough liquidity for me to trade $50,000, $100,000 positions and not worry about it, right? So in general, I would like if we had to put a number on it, I would say you should look for like a couple hundred at least of open interest and volume, right, on those contracts. But only go through that process if you're trading like a really funky outlier name. Like even the names like Snow, Airbnb, Home Depot, those are some of the lower liquidity names out there in the sphere, and I never even have issues with them. I would never worry about it. So for me, I don't personally look at open interest or volume, but if you're somebody that's trading a very obscure name, maybe it's like a small account name you found on a scan that I'm going to teach you in lesson 8, then I would check open interest volume. But for me personally, I don't check that on a frequent basis, right? I'm sorry, everybody. My mom just keeps texting me, and I'm in class. Sorry. It's just shit. And now I'm like, I'm in class, so I can't talk, and then continues on the conversation. Like, all right, it's okay, you can talk about it later. It's like, stop. I'm not like, I can't talk right now. Ah! Okay, so pause. Let's re-grasp ourselves that conversation. It's not urgent. It was not something urgent. Yeah. All right. So first part of our equation that we look for is a 0.30 to 0.50 delta, somewhere within that range, right? Next, I look for something that is a round number, right? I like those round numbers. Next, if I need to, if it's applicable, which most of the time it's not, I'll check the open interest and the volume, which I haven't done in years, right? Next, we have different types of trades equals different strike prices, in my opinion, right? If you're going for a swing trade, you're likely going to be using a trade that factors in the target price a little bit more to that equation, right? So a scalp, I'd sometimes be using a different contract than I would be on a swing trade, right? But the ultimate question is, where is the target, right? Where is the target on this trade? And how can we use that target to sort of calculate our risk to reward, right? So let's talk about a trade here that in this example here. So let's say that I was looking at Snow on any individual given day. It might have been today, but these options prices don't line up with today, but let's just, for our purposes, pretend that they do, right? Let's say that I entered a Snow trade, right? The 190 calls at 125. My target on the trade is 200. I think Snow can go to 200 on there, right? This position I have sized for 0, which means that I have no stop loss. If it goes to 0, it goes to 0. No harm, no foul, right? So if I am using, right, basic R multiple targets, right, which again, we talked about this in lesson 2. So this is start of the beginning of where everything starts to come together a little bit, right? If we are using R multiple targets, if we want to be risking at least 2 to 1, right, we would want the contracts to be worth at least 375 in order for that trade from an R multiple perspective to even be worth it for us, right? So if the target is 200, that means that we're aiming for those contracts to be worth 10.0. Why? Because of intrinsic value, right? Like we talked about with this AMD example, there is a formula for calculating the intrinsic value of an options price, right? Right. So here on Snow, right, we can determine that at 200, right, we know our 190 calls will be worth at least 10.0, at least. Why do we know that? Because of intrinsic value, that equation that we talked about earlier, right? So at 188, let's say I took this same trade, right, but my target was 188. At 188, am I going to be able to calculate exactly how much the bare minimum of what my contract will be worth is? Maybe you could use delta, but if the trade takes longer than you think, probably not, right? So one of the things that I always pay attention to is where is the target on the trade, right? Where is the target, right? I want to make sure that at the end of the trade, if we hit my target, I know exactly how much at least my contracts will be worth, right? So let's say Snow is trading at 184. These slides might have been out of order, and I think they were. Let's say Snow is currently trading at 184, right? The target is 200. The target on Snow is 200 for this particular trade, right? Let's go through process of elimination using our formula here. So the first thing that we look for is number 1, a delta within the 0.3 to 0.50 range, right? So if you check the charts at this particular example, which it's pretty similar example to right here, right now. I don't know if it's going to be entirely accurate. It's probably like $5 lower, but if someone's trading at 184, 0.3 and 0.5, that leaves us with either the 185 calls, the 187.5, or the 190 calls to potentially choose, right? So then we go into our next process of elimination, number 2, that we look for round numbers, right? For us, that eliminates the 187.5s. If both of the 185s and 190s are inside of our delta range, then I don't need the 187.5s. I'm not going to use them. I'm either going to use the 185s or the 190s, right? So next we ask ourselves the question, right? The third and final one, which is, where's the target, right? If the target's 200, then either 185 or 190 will work, because at 200, we'll be able to calculate exactly what that option will at least be worth, right? So let's say here that the target was actually 189. If the target was 189, right, then I would choose the 185 calls, because then at 189, I know those are going to be at least worth 4.0 based on the intrinsic value, right? So I always like the strike that I'm choosing to be inside of my target range, right? That being said, if I had to choose, if the number was the target was 200, let's go back to the original example. The target is 200, right? And now I have to make a decision. Am I going to choose the 185 or the 190s? For me, it's a little bit of a difficult question, a difficult answer, because it's a different answer depending on whether you're asking me, Jake, the person trading, or Jake, the person giving signals, right? I will, if it was just me locked up in a room by myself, I would all day, every day trade the 185s. I like 0.50 deltas, right? But there are times that I'm trading and I'm factoring in small accounts and everything like that, where I'll go with a more out of the money strike as long as it still fits the rest of my criteria, right? Still has to be within range to target, still has to be ideally around number, and still has to be within that delta 0.3 to 0.50 type of range, right? So why 0.50 deltas? For me personally, it's the easiest to calculate stop losses, right? Now, we will use the options contract chart, which we'll talk about more in lesson 8, but we've already talked about a little bit, right? But we like to use 0.50 deltas because it's quick maths, right? It's easy maths, right? If the stock is trading at 100 and we place a stop loss at 98, $2 beneath it, if we purchased a contract at 4.0 with a 0.50 delta, if the stock moves down $2, we can use that information that we learned from the delta slide up here to do the very basic calculation that, okay, stock price moves down $2. We have a 50 delta. Our options would move down roughly $1, right? So that's why personally I like 0.50 deltas. I also just like the way that they move the most, right? So again, one more example here. NVIDIA closes at 282.12, right? I want to swing a swing long here. And in the process of choosing a strike, you go that first step, looking, is it 0.3 to 0.5? You go step number 2, is it a round number? Step number 3, what type of trade is it? Step number 3, where is the target? And boom. That ultimately gives you all of your answers, right? After running through this process, you can determine what strike prices are in the range that you have the ability to purchase. And I think like that's what I would do, so to speak, right? So, all right, with that, let's continue on here, right? Let's review really quickly what we talked about before we dove into strike price selection, which is the definition of long call options, right? Long call options are an inherently bullish strategy. We pay a net debit to purchase these calls. They do require directional accuracy, aka in order for you to make money, you have to be right on the direction of the trade. The max risk, if you purchase those calls, are the price that you paid. Your max profit is, in theory, unlimited, right? So let's say you purchased Apple calls at 1.0. The max you could lose is that 1.0. You can't go like -6 on Apple calls that you purchase, right? And in theory, Apple could rally tomorrow and open up at $16,000 a share and then run to $30,000 a share, and your profit would be infinity and beyond, right? It can just keep going and going and going. So in essence, when we want to go long on a stock, one way to do so is to use call options. How would we choose a strike price? Using the process that I just talked about in the previous slide. Right. Next up, moving down the list of various option strategies that we are going to cover is short call options, right? So when you purchase this Apple call at 1.0, there's somebody on the other side of that trade, right, who's taking it, right? So there's somebody on the flip side of that, right, who is selling you that call at 1.0. It's most likely a market maker who's simply there to fill an order. They remain delta neutral, but it's somebody there filling the other end of that order. They are going short on that call option, right? So this is an inherently bearish strategy. It receives a net credit. The max risk is unlimited. And that right there is why we are going to stop this conversation on short call options, because it's unnecessary to continue talking about them, because in my opinion, you're never going to do them, right? Maybe when you have an extremely large portfolio and you're risking 0.5% of your account on a short call option as a day trade, is that possible, right? But in order to do that, you need to have a six-figure account, multi-six-figure account, right? Selling naked call options is extremely risky. Once you have years of experience with options, you can start to dabble with defined risk in combination with other strategies. But for now, never sell naked call options. All right? Now, the last one we're going to talk about tonight is the opposite of long call options. It is simply long put options. I imagine all of you are familiar with these, right? It's an inherently bearish strategy. We pay a net debit to purchase those put contracts. They do require directional accuracy, aka in order for us to make money, we have to be right if the stock goes down, right? The max risk on these contracts, these puts, is the same as it would be on calls. Whatever you pay is the absolute max you can lose. And the max you can make isn't infinity on puts, but if the share price goes to zero, it's pretty damn close. Right? So in essence, when we want to go short on a stock, one way to do so is to buy put options, right? So for me, I follow the same thought process when I'm selecting a strike price for my puts. It's that 0.30 to 0.50 delta, the round numbers, and really the end of the day, biggest question is where is the target, right? Where is the target on this trade? And can my option go from out of the money to in the money, right? That is where you'll see that significant increase in value. And that is where we kind of align our technical analysis with the selection of a strike price, right? So with that, my friends, I know it was thick. I know this was a whole lot of PDF slides. This probably felt more like a college class than any of our other lessons. Although I promise you, I literally would not spend this time on this material unless I believed it to be fundamentally important and instrumental to you succeeding as an options trader and using the strategy that we use, right? In order for us to break down, right? If you think about it, really the biggest takeaway that I wanted you to have from tonight's lesson was here. How do I select an options strike price, right? In addition to that, I wanted you to have a good understanding of options. That way you're not shocked when a 0-day expiration option goes to zero, right? However, again, the biggest takeaway was this part. However, to actually get to this end game mark of talking about how we select a strike, I couldn't have gotten there without explaining intrinsic value, without explaining the Greeks, implied volatility, expected moves. I know this stuff isn't the sexiest topics in the world. I know everyone's like, Jake, show me another fucking chart so we can do more chart shit. I know, I get it. However, I literally have a responsibility as an educator to you all to set you up to succeed. And if I don't cover this material because we want to talk more about charts, I'm not putting you in a position to succeed. So instead, I found a middle ground. We cover this material in depth, but in a concise way, faster, like I mentioned, faster than any other way, in my opinion, you've learned options before, just because I'm not giving you any fluff. I'm just giving you the meat and bones that you need, right? And the middle ground that I found is for those of you who want more charts, you have 20 more bonus lessons. And I'm not, and as it currently stands, most of Mastermind 10 has not completed those bonus lessons. I don't expect you to have, but I'm just saying you have more technical material to watch in the near future, right? So that being said, my friends, that wraps us up for this evening. We're going to circle back tomorrow night. We're going to talk about more advanced options strategies, and then we're going to talk about what futures are, how they move, how you can trade them, and how you could potentially get a funded account of like $100,000 trading account to trade futures with, right? That's not your own money, right? It's very cool. So that being said, I love you all very, very much. I hope you had an awesome day, an awesome week, and I cannot wait to get back at it tomorrow night. I love you all. Gang, gang, baby. I'll see you all tomorrow. All right. I love you. Let's go.